Every now and then you come across a company that seems to be living this bizarre double life. And today, we're looking at a prime example, Interactive Strength, or TRNR. On one hand, they are posting absolutely mind-blowing triple-digit revenue growth. But on the other, they're literally fighting to keep their stock from getting kicked off the exchange. So how on earth can a company be soaring and sinking at the exact same time? Well, let's dig into their 2025 performance and find out.
Look at this. It really is a tale of two companies. You've got this incredible 114% revenue jump in 2025. Those are the kinds of numbers most CEOs can only dream of. But then you look at the other side of the coin, and they are in a desperate fight for survival on the NASDAQ. That is just a massive red flag that something is seriously wrong under the surface.
So this is the big question, isn't it? How is this even possible? How can a business be hitting absolute home runs with its top-line sales numbers, but at the same time be standing right on the edge of a financial cliff? That's exactly what we're going to unpack.
To get to the bottom of this whole paradox, we've got to pop the hood on TRNR strategy. We really need to peel back the layers one by one to see what's actually driving this thing. Okay, so the first thing we find is a massive growth engine. But this isn't the kind of growth that comes from, just selling more of your own stuff. Nope. This growth has been bought and paid for through a really aggressive acquisition strategy. What TRNR is doing is using a classic M&A roll-up strategy. Put simply, they're on a shopping spree, buying up smaller fitness companies to quickly bolt on their revenue and grab market share. It's a way to get huge fast. But as we're about to see, it is incredibly risky. And what they've put together is actually a pretty interesting mix of brands. You have Wattbike, which is the absolute workhorse for professional athletes. We're talking NBA and Formula One teams. Then there's CLMBR, which is all about that trendy boutique gym vibe. And finally, you've got Form, which is this super high-end luxury experience for fancy hotels and universities. But here's the kicker. The acquisition of Wattbike in mid-2025 completely changed the entire game for this company. Just look at this. It now makes up a whopping 71% of their revenue. This isn't really a diversified portfolio anymore. For all intents and purposes, this is the Wattbike show. So they're buying all this growth. Fantastic. But how are they paying for it? Well, this is where the story starts to take a pretty dark turn. They're funding these deals with some seriously high-risk and very expensive financing. First step, we've got a ticking time bomb of debt. We're talking $14.8 million that is due within the next year. That is a huge bill that's coming due, and it's coming due fast. And to pay that huge bill, what do they have in the bank? A little over $500,000 in cash that they can actually spend. The gap between what they owe and what they have is just staggering. So to try and fill that gap, they're turning to what you might basically call financial loan sharks. We are talking about loans with absolutely punishing interest rates, between 12 and 15%. This is the kind of expensive money you take when you have almost no other options left. But believe it or not, even that wasn't enough. So in a move that you'd expect from a crypto hedge fund, not a fitness equipment company, they made a massive all-or-nothing bet on cryptocurrency to try and raise cash. And it went about as badly as you could possibly imagine. They took out a $50 million loan using a crypto token as collateral. Then the crypto market did what it does, and it crashed. The result? A catastrophic $27.7 million loss. They might as well have just set a giant pile of money on fire. So all of this financial pressure, it's starting to cause some serious cracks in the very foundation of the company. And we're now seeing some major red flags pop up in their day-to-day operations and just how the company is being run in general. This chart right here really says it all. They are slashing their R&D budget, the money they use to innovate and build better products, by more than half. And they're pouring all of it and more into sales and marketing. For a company that claims to be a tech innovator, this is a huge warning sign. It shows they're prioritizing short-term sales over long-term survival. And somehow it gets even worse. Now, this isn't some analyst's opinion. This quote is from TRNR's own official report. They are admitting, in writing, to material weaknesses in their financial controls. That's like a pilot coming over to intercom and admitting they're not really sure the plane's instruments are working right. It is a massive risk for any investor. And this right here, this might be the fatal flaw. They actually make a decent 24% profit on the hardware they sell, That's pretty good, but for every single dollar they make from their subscription service, which is supposed to be the core of their high-tech business, they are losing more than $1. It's like a restaurant losing money on every single meal it serves. It's just completely unsustainable. So, after all that, where does this leave them? Well, basically, 2026 is shaping up to be a do-or-die year for TNR. They are walking an incredibly thin tightrope, and just one wrong move could send the whole thing crashing down. As one analyst from HDIN Research put it so well, TRNR is performing a masterclass in financial gymnastics to stay alive. They are pulling all these incredibly complex, often desperate moves just to keep the lights on for another day. So, if you're watching TNR, here's what you need to keep an eye on in 2026. Number 1, can they finally fix that broken subscription model and make it profitable? Number 2, can they stop burning through cash at this insane rate? And number 3, watch out for debt for equity swaps. That's when they pay off their debts with company stock, which is kind of like adding more water to a drink. It just makes everyone's share a little less potent. And all of this leaves us with the big, multi-million-dollar question. Can all this clever financial engineering and M&A magic actually save a company that might have a fundamentally broken business model at its core? It's a race against time, folks, and right now it is anything but clear who's going to win.
And just a quick final reminder, this has been an independent, third-party analysis. It's for educational purposes only, and it is definitely not financial advice. We're just trying to make sense of the story behind all the numbers. Thanks for tuning in.